Welcome to What's Hot and What's Not in CRE, your daily pulse on commercial real estate in America. I'm your host, Rachel. It's December 2025, and as we head into the final weeks of the year, the multifamily and residential sector is a tale of two very different markets. So, let's dive right into what's moving the market this winter. First up, let's talk about what's hot. And honestly, the big story right now is coming from a place that's been overlooked for years, the Midwest. That's right. While everyone was chasing returns in the Sun Belt, cities like Chicago, Detroit, and Baltimore are now quietly outperforming almost everyone. Why? It boils down to one simple, powerful factor: supply constraints. These are mature markets that didn't go crazy with new construction. Take Chicago, for instance. It's facing a documented shortage of over 800 apartment units heading into 2026. This tight inventory keeps occupancies high and gives landlords pricing power. It's a classic case of disciplined growth paying off, while other markets are absolutely drowning in new inventory. Our second hot item is a win for tenants. Concessions are everywhere. Move-in specials, 1 month free, waived amenity fees. Landlords are in a fierce battle for tenants, and it means renters finally have the upper hand. The data is striking. Nearly a quarter of all Class C apartments are now offering move-in incentives. To put that in perspective, that figure was just 18% a year ago. It's a renter's market, plain and simple. Now, you might think all this softness would scare away investors, but that brings us to our third point. The capital markets are heating up. After a period of caution, the money is flowing again. Multifamily loan originations are projected to hit $390 billion this year. That is a huge jump from the $297 billion we saw in all of 2024. Despite the turbulence and negative headlines, institutional investors are clearly betting on the long-term strength of apartments. And finally, on our hot list, we're seeing some former hotspots rebounding. Markets that got hit hard by overbuilding, like Charleston, Durham, and Boise, are coming back strong. The pipeline of new deliveries has slowed to a trickle, and that's finally allowing demand to catch up and absorb the vacant units. Occupancy is climbing again, proving that these markets have strong underlying fundamentals. Okay, let's flip the script and look at what's not hot. The number one story here is, without a doubt, the Sun Belt oversupply crisis. It is the hangover from the development party of the last 3 years. Austin is the poster child for this issue. Since the start of 2023, developers have delivered a staggering 58,000 new units in that market alone. That's nearly 3 times what the actual demand can support. This excess supply has pushed the national vacancy rate to about 9%, which is roughly 200 basis points above the long-run historical average. There are just too many shiny new buildings sitting empty. This leads directly to our second not hot item. Rent growth is stalling out. Actually, it's worse than stalling. It's declining. The national median rent slipped another 1% in November, landing at $1,367. That marks the 4th consecutive month of decline. If you look at the year as a whole, effective rents are up just a measly 0.6%. That's essentially flat, and well below the rate of inflation. So, who is supposed to be renting all these apartments? That brings us to our third problem. Young renters are sitting out. The core demographic for new rentals, young adults, are delaying household formation. With high costs for everything and a somewhat soft job market, more and more of them are choosing to stay at home with their parents for longer. This is shrinking the core renter pool at the worst possible time for landlords with vacant units to fill. And finally, the luxury apartment segment is struggling the most. All that new supply we talked about? The vast majority of it is high-end Class A product. As a result, Class A vacancy is now pushing nearly 8% nationally. Meanwhile, older, more affordable workforce housing in the B and C range is holding much tighter, with vacancy around 5%. It turns out, in this economic climate, affordability is king. So there you have it. A market of contrasts. A disciplined Midwest on the rise, and an overbuilt Sun Belt paying the price. That's your CRE Pulse for today. Thanks for tuning in. We'll see you tomorrow on What's Hot and What's Not in CRE.